Michelle, welcome back to Face. How are you?
I'm great, Dale. How are you? And thank you,
Uh,
Blake, by the way.
You're welcome. Great to see you, Michelle. I'm going to pass Mish over. All right. See ya.
got her.
I'm
He
got.
threw a spiral. He threw you in a spiral. Anyway, Michelle, what's top of mind for you with everything that's going on here? We came through a lot of stuff, debt ceiling, uh, uh, hawkish skip. Bernanke's playing hopscotch. Now he's skipping around. Um,
Bernanke.
Bernanke. Yeah, that's right.
I like the Freudian slip.
They're all Bernanke to me, Mish.
Exactly.
Huh?
We
Yeah.
stopped at Bernanke.
Yeah, no, it's 5:30. So, and I am really, I'm getting a little not as sharp mentally as I used to be. So, I forget things. So, ever go into a room and ask yourself, why did I come in here?
Yeah, but I've been doing that my whole life.
All right, so I'm a little better with the markets than taking care and guiding my life. So, what is really the key development? And I talked a little bit today about the grains, and I've been telling people to build silos in their backyard for about 6 months or a year and store some wheat. When we talk about a super cycle in commodities, I'm not sure that it's really gold and silver or oil, but I think it's more of the agricultural ones, and we've had everything else happen. We have wars going on, so we've had pandemic. So now I guess we're due for famine.
Well, this is a very good point and an interesting place to start because, like you say, there's so much going on. We can talk about a million things. So since we don't have time for a million things, let's start there. Yeah, you and I have talked about this for a while, that food was going to be the stickler, if you will, in terms of persistent inflation. And it's probably the one thing that is really hard to interest rate way you're out of, because you can raise interest rates, but it's very hard to do demand destruction on basic staples. And obviously grains would be in that category. I think that the reason why we saw the big dip from the highs in the grains was because there was all of a sudden an alleviation of some of the supply chain issues.
Yeah, with Russia.
Right.
Russia. Okay.
But I think Russia is it's very hard to know what Putin's going to do right here. I think there's two ways it can go. I just kind of not that I have any insight into the psychological profile, so let me just say that, but just from a speculation of when somebody has the back against the wall, right? What do? It's fight or flight. So if we look at that, he can either be a desperate person and just say, that's it, I'm taking this to a next level, which he's threatened, or he can, disappear and go into exile somewhere. We don't know. But what we do know is that Mother Nature is here. And I read yesterday that even the Russian wheat crops have been impacted by drought. And of course, that's what we're seeing here in the U.S. Those reports came out last week from the USDA. Some more crop reports came out yesterday showing that there's just not enough, even here in the U.S., and they've certainly had problems in other countries as well. So this is going to be the key for inflation. We've seen demand destruction in many other types of commodities, obviously, and I read today that copper went down a lot in the LME after the Bank of England raise. But in terms of food, I think what happens is, and this is what you were alluding to, Dale, is if people don't have enough to eat or they have to pay ridiculously high prices in order to eat, that's where the social unrest factor comes in. And that's kind of that would be, I think, the worst case scenario for everything, geopolitics, for just life in general for people.
It trumps everything, excuse the pun.
Yeah, it does. It absolutely does. And, we haven't seen it that much in society, but it's certainly possible right now. And so we'll see what happens. I mean, I'm really hoping that doesn't happen, but I'm certainly prepared for what if it does. And I heard
Grande
you
El Nino.
exactly El Nino. I mean, here in the Southwest, not that we're a big growing region for anything but chilies, but what the weather here has actually been sort of the opposite of what you usually think about. We're usually very dry. We were very wet, but now we're heading into the dry season, and that's the problem. So you're going to have hurricanes and floods and typhoons and tornadoes in some areas of the world, and then you're going to have this persistent drought in others. So like I said, it's going to be how much it affects people, and raising the rates just aggravates people even more and doesn't necessarily control this kind of inflation.
Yeah, they can't print corn. Do you remember trading grains in the 70s, 80s, and in a weather market, you bought rain breaks?
Right.
If it rained, it gave people the bears some hope that prices would come down and we'd get a good crop in. So I was telling people, you buy the rain.
Right, except that we're now in the point of the season where too much rain would be just as damaging. So a nice light sprinkle to give some relief, yeah. But there's already been a lot of crop damage.
Okay. So I want your take on what you see here in S&Ps. We've had this huge performance. Are you in the camp that we've started a new bull market, Michelle?
No. Let's put it this way. I measure my bullishness on what the small caps, retail sector, transportation sector do. And, those are my inside sectors of my economic modern family, and they're there for a reason. And then, of course, semiconductors, which is also in the family, has led this way up. And we've seen this before. We've seen technology, growth stocks, semiconductors lead in other bull markets. And it always gets to the same point where they lead and they run and everybody piles in. And I have to say, happily, the retail investor has done very, very well. And it's been more on the institutional side that they've not only been bearish, but selling into this, but they've totally refused to participate. So once the Russell 2000 got up, so I think last time I was on, we talked about that 23-month moving average and how it was a 2 cycle within a 6 to 8 year cycle. Well, the S&P cleared it, semiconductors cleared it, even transportation now, which is like our best hope right now, has cleared it. But the Russell 2000 got right to it. And the reason why that's
right
important,
up there, 87. Yeah.
It was like 190. I mean, it was almost like,
okay.
Actually, it's a little higher. It's like 193. But I kept thinking that have fun, have a party. And certainly we did. I mean, we have these quant models.
It was a hell of a rally.
Oh, my God. And we had so much fun in NVIDIA and in Meta and AMD and AI and, and a few others, and semiconductors themselves, the ETF, and even the indices, Qs, and SPY. But the nature of how we trade is to take profits along the way, and we still have tails on most of that stuff. So if we get a much more severe correction from here, we'll get out, either a break even or a little bit of profit, but we're certainly not adding at this point. And I think that's the math. But if I'm looking at it as an analyst, it's because we're not really seeing any true expansion. We saw expansion in growth stocks because there was this flight to safety, and then it became almost like a mania. But if you look at the small caps, which, if I were talking to an 8-year-old, I would say, well, that's Russell 2000 makes stuff in America. And so we have to see, we have to see a point where that's expanding to where it trickles into a growth in the economy and the GDP. And we're not seeing that yet. All we're seeing is it got right to the resistance while everything else was flying, and now things are starting to come off. So we got to watch those. I'm sorry, go ahead.
No, it's okay. I think that the issue for business in America is expressed by what's happening with the regionals. And I don't know about you, but no one's worried about our banks anymore. It's like we just solved it. Yellen says there'll be consolidation. To me, that's code word for more failures. And this chart on the regional banks, doesn't look especially good to me. All it did was recover with a blow off in the market. And I think it's destined for new lows. That also could put a damper on Russell stocks, because that's where, that was their central nervous system to get things done, were these banks, where they knew the people, knew the businesses, and they had lines of credit to do business. And that's going away. Do you think the banking crisis is over?
Well, I would venture to say whether it's over or not, but to your point, and it's interesting how the relationship of the Russell 2000 and the regional banks, which is also a character in my family, and I call the Prodigal Son. And Dale, no one knows the Bible better than you, but you know the story.
Or the Prodigal Son.
Right.
I've run away quite a few times.
Well, the Prodigal Son, right, in the Bible, I mean, and I'm giving a very rough sketch of it. It's not like I'm an expert on it by any means, but it's always struck me is that he came back, asked for forgiveness after squandering all the money, and his father, in this case, grandfather, if you will, for the Russell 2000, did actually give him back the money, which he squandered again. And that's really what happens with the banking system, and has happened for decades. I mean, this is not a new thing. What's interesting about it is that it's affected the regional banks more than the big banks in this case, because that's also very tied to commercial real estate. And people talk about that as this catastrophic event in the making. I've heard statistics like in New York City, for example, there is basically a 50% vacancy rate in commercial real estate right now.
No one wants to go back to the offices.
But,
right. It's not only regionals, though. Look at Goldman.
Right.
Goldman looks pretty. The XLF looks exactly like the regionals, except the magnitude of the first drop.
Exactly. Getting back to your point, we have to keep an eye on it. Absolutely. What was so amazing this year alone is that the regional banks in March were the reason why we went down, member of the Modern family, and it was Sister Semiconductors, I like to call her Sister Semiconductors, is the reason why we were able to carry back up. And everybody else in the family kind of got dragged along, but up into this resistance. And I think you need to look at the retail sector here. If you look at XRT, that's the one I like to use. And mainly that's because it's a good combination of staples, discretionary, and that also hasn't exactly been wowing throughout this entire rally. All it's done was prevented. So we went back to that 23-month moving average, which would be a good place because it would show after 2021 expansion coming from COVID, 2022 contraction with interest rate hikes, and 2023, we don't know. The first 6 months was an anticipation that the worst was over. Except
was that XRE?
That's XRT. XRT.
Okay.
Yeah, let's put that.
Go ahead. Sorry.
Right. And the consumer, meanwhile, I mean, yes, we see the consumer alive in restaurants and traveling and in shopping and things like that. I still see gold. Oh, there we go. Yes, there you are. Is that
not impressed? Yeah, that's it. The retail.
Yeah,
ETF
and if you look at the 23-month is much higher, never got there. And what's concerning me, and people say, well, do you think we're going into a recession? I'm still going for stagflation here, except if this particular ETF breaks down under, right now it's trading at around
62.20.
Right. If it can get back over 63, then we've absorbed another shock with the Bank of England. And right now, people probably not really believing that we're going to have any kind of reinflation anywhere. If this breaks down, though, to me, this would be a very key indicator right here, even more than the banks. If this breaks down, let's say under 50, 56, this is 70% of the GDP consumer. Then we really know we're starting to see some level of real demand destruction, number one, and concerns about recession. And so right now we're sort of back in that stagnation where it's not wowing anybody, but it's not necessarily in the danger zone. And so from the overall macro picture, I'm sticking with stagflation until proven wrong, essentially.
Oh. Okay,
and that's what they're saying in England right now, and then in terms of the housing market, I mean, that's a whole other interest. I
mean, the housing stocks have been like Bitcoin of the,
exactly.
I mean, when parabolic moves. Yeah, the home
Right.
builders.
Which, again, was over inflated by the, for lack of a better word, by the media, that we were having some kind of a housing crash and crisis, when I was thinking to myself, well, if you go back in history, 5 to 7% interest rates to buy a home was actually pretty much the norm. There's still a lot of shortage of supply. And you have this sort of really almost a reconfiguration of the United States, where people are still flocking from California in particular. And I say this because where I live in Santa Fe, we've just had this population explosion with a housing shortage. And I know there are other pockets in Colorado, and even if you look at something like Austin, Texas are having the same kind of issues. So I never thought we were going to see a crash. To me, a crash would mean that people are just stop buying homes and there's too much supply. And I haven't really seen that yet. So that's
who's going to give up a 3% mortgage? How could there be a crash? The only way we get supply on the market is BlackRock goes BK, and all these hedge fund landlords have to cough up the homes that they own a good percentage of homes in the country, or people lose their jobs because they'll walk away from their car loans, their credit card loans, but not their house with 3% money. They'd have to lose their job.
Right. And this is the kind of thing when you see sort of a quiet revolution that can happen if food prices in particular get too inflated and people get fed up with a lot of things. And again, not to be political, but the government spending is out of control. The money that I've been reading headlines that are going still into the military spending. I mean, we're still a country that, regardless of what the narrative is from who's ever on top, we still spend a tremendous amount of money on the military and protecting other countries, and not as much in our own supporting of the people here. And that's really where you're starting to see in other countries, like what's happening in the Sudan. France. Oh, France loves they just love to revolt over everything. I mean, that's like a big thing about being French. But it does give you, and I don't mean this as an insult to the French. I think it's great, actually.
They love drama.
They love drama, and they're very inventors.
I know. I have a French friend, and he would always come to me when there was a problem here. He goes, why aren't the people in the streets? They're just going about their business. How come they're not all in the streets? I go, I guess it isn't bad enough yet, but
we're still very, very complacent. And regardless of what issues come up politically, really the only thing that makes people finally throw in the towel and decide to do something about it is when it really hits their pocketbooks. I mean, that's also just go back to the Revolutionary War. It was the taxation without representation, kind of the final straw.
Tale of two cities.
Right. Yeah. Well,
don't you feel that way? When I hear guys like Larry Summers, who is blue blood and went that route, and talks about the surprising strength of the economy. I say, Larry, come out of your ivory tower and go into our cities. Then you'll be surprised.
And by the way, that's part of the problem that's happening with the analysts from the big banks is their number. Anybody who's just crunching numbers right now can't necessarily be getting it right. And that's been one of the problems. But, and Dale, you and I can have philosophical conversations about the world. But let's go, let's do something.
Let's go to metals, because I know you've liked silver for a long time, and it's had hopeful moves, and gold has had hopeful moves, and the action the last couple of days has been, even with a weaker dollar, the metals haven't performed. Do you have levels lower where you're looking, if you have an opportunity to buy silver?
Well, silver right now, right where it is right now, is starting to look relatively interesting to me, because
look, it's right at the 200.
Where it is. Yeah, it's sitting right there. And just below that, you've got a couple of other moving averages. But, we're looking right now, again, at that 23-month moving average. Silver has not broken down beneath it, or it did, but it hasn't really broken down enough to be substantial. So it's still showing me, if you step back, it's in a period of expansion. It's just correcting. So the question is how far is it going to correct? Now, we had gotten out of gold, because we're traders, right? We're not going to sit, we're not buy and hold. And I don't care what it is or how much I love it. We're never going to be a buy and hold.
You have to be tactical in every asset class right now, or you're not going to make a living.
And that, I think, is the biggest and probably greatest lesson of 2023 is, if you didn't get out of some of your NVIDIA at this point and you're looking and you're looking to buy more, well, then basically you're trying to compound in a very scary situation right now in terms of how the overall global economy is. And that's the thing about inflation, by the way, is people forget it's global, which is the first time we've had this much global inflation, even more so than what we had in the late 70s. But getting back to silver right now, it's interesting because, yes, this is probably why people argue with me and say we're going into deflation or disinflation. Just look at the metals. But look at the metals. I mean, they're still way higher than they were. They're still so incredibly, particularly silver, so undervalued. When you think in 1980, it was trading at $45 an ounce. And now it's more than half than that, while we're still, much, much higher than we were in certain equities. And certainly if we look at the Dow Jones Industrial Average at 34,000, it makes you wonder, it does make you wonder, how far can that rubber band be stretched before silver starts to catch the bid? So I say at this point now, I'm watching these levels very, very carefully right here. I wouldn't be
I have two moving averages right around the 22 level. Looks to be a pretty important level. And you know what kind of tipped me to not feeling like I should have FOMO in silver were the miners. The miners had already taken out the March lows. Here's SILJ. Here's the March low. We've taken it out. Here's some juniors. They've taken it out. They don't look great. And even some of the golds, like Newmont, could still be, and we didn't, when we had big up days in the gold, GDX did nothing. I think that we could see 27 again in GDX. But I want to see a day like this, Michelle, that gold is down $20 and GDX is nearly unchanged. And that will be the time to really pay attention to both, because I want to see the miners begin to show relative strength. They're leading this decline, in my view.
Right. And, the space got, again, very heavily bought.
It did.
Think about how many people thought that gold was just going to go from 2,000 right on up to 3,000. And of course, that didn't happen. And so, I think that's a very smart point to look at the GDX to see signs of it actually starting to outperform or at least to base out while gold. But, getting back to silver for a second, if silver breaks down under those moving averages and then comes back through it, I think that would also be just like they broke out and then came back down. I think that's been the nature of the metals, is that when they look great, it's time to consider getting out. And when they look like dog do, it's probably time to start considering buying. And gold was really being used as a flight to safety throughout the beginning of this year when it was having its big rally. And now that has switched back to, I'm starting to see the conversation, Bitcoin or gold. And I think Bitcoin's rallying for different reasons, but as more and more ETFs are starting to come out from companies and more of a mindset of a mass adoption, or I should say adoption of Bitcoin, and gold is still at this point. So there's one other instrument, though, that I think it is so important to watch right now.
Let's wrap it with that.
Okay, and that's the long bonds, and because you just put a bond, so you just.
All right, can I use TLT for TLT for a proxy?
Yeah.
Okay.
Why? Because in our risk gauges, we use the long bonds as a measure against junk bonds, as a measure S&P 500, those two in particular, to see whether we're in a risk-off or a risk-on environment. And it makes sense, right? If the long bonds start to go up, classically, even though we haven't seen that in a while, it's a flight to safety. And if they start to outperform the S&P, and if they start to outperform the high-yield, high-debt bonds, which have done pretty well.
They're doing that in the last week.
That's two warnings. Number one, it's a warning that a bigger correction could be coming. And we maybe saw the top of the trading range at 440 is instead of 420 that people thought, because right now 190 was the top, obviously, in the small caps. So it could mean we're going to find some bottom of the range. I don't think we're going to see a 25% crash or anything, but we could easily go back down.
I do.
Well, you do. All right. Well, we'll see. I'm prepared for anything.
Okay. And I think
one,
this is part of the narrative. And you know, the Fed pause. I could see the 10-year, if we get under 360, is a key level for me, then 330, and then 280. And I think that these moves are going to be because of risk off.
If risk off happens, and it's because the yields actually start declining, as opposed to in the face of everything we talked about in the beginning, of this type of persistent inflation that really basically Mother Nature has another thing to say about it.
Right.
But, you know, and completely is in the face of whatever the ECB is doing or whatever the Federal Reserve is doing here, then that too, with yields coming off, means that things are a little bit out of control. And if things are out of control, where are you going to go back to? And that's what I'm being patient about. You're going to go back into gold, and you're going to go back into silver, and the dollar might have some more issues, and you won't necessarily be going back into the classic equities, and even growth stocks will get.
And your long duration, you get long duration because all the regionals that held them from 2 years ago are probably, you know, liquidating them. And
and by the way, we are from a discretionary point, we have a position in TLTs because it had this incredible island bottom in March. You could actually see it right there. Yeah, that little nice.
No man is an island.
Well, it wasn't a class. I mean, a new true.
It's good enough.
Exhaustion gap. Let's call it that.
One candle. That's Gilligan.
Yeah, exactly.
The Gilligan or Tom Hanks left alone on the island.
And when we came off more recently, we tested close, but we held it. And so that's why now we get through these levels right here around 104, which we haven't been able to head over. Then
look at these moving averages.
I would prepare for a bigger rally in the bonds. I would prepare for more pain in the equities. And then I would start keeping my eyes on the inflation indicators, and particularly, again, that might be when the precious metals come back into vogue.
Yeah, so we got the takeaway is the bonds are saying be careful, there could be risk off. And when there's risk off, they sell everything. But those are opportunities when that happens.
And nobody's been thinking bonds were any kind of safety play for a while. So that's just when I start paying attention. When everybody
over 109, it measures about 120.
Yes, I actually, right. We, you know, again, think
140.
Of the, I think 110 is a very, very key area, but you know, it's more, I mean, have fun with the trade. And like I said, we're in it. And if it breaks 100, we're gone. I mean, it's that simple. You can even say if it breaks 102, we're gone at this point, because it's been holding 102. And that's a really tight risk. But just think of the implication to everything else, because to me, that's the key area of saying, probably even if they raise more, it's not going to be by too much, because they're going to be extremely aware of killing the economy. And number two is maybe they've lost a little control, which is the type of chaos I've been feeling kind of calm down, but we're getting into the second half of the year, so things could get interesting.
Michelle, again, great to talk to you on the solstice, and have a great trading season this summer. You and Keith, I'm fans. Here's where you could find Michelle if it's not on Twitter at Market Minutes. They write prolifically, and you've just heard. I've always said that Mish is one of the best intermarket relationship analysts out there. Used to be John Murphy, and he was replaced by Michelle Schneider. So check Michelle's work out. Thank you so much, Michelle. I look forward to seeing you every 3 months or so and getting caught up, and I learn from you, or you reinforce some of the things I've been thinking. So you helped me today, Michelle.
Thank you so much, Dale. That's so kind of you. I hope you stay well. And thank you, everybody, for listening in today.
All right, everyone. At Market Minute, Michelle Snyder, and follow her and learn. And plus she offers actionable trading ideas and programs and everything. So thanks again, Michelle. Look forward to seeing you down the road. Say hello to Keith. And you're a great watchman for us on markets, and your modern family really does tip us off to why we all want to be hermits.
All right.
Anyway, great laughing with you, Mish.
Okay. You take care.